Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to episode number 81 of That Annuity Show. Imagine that, and welcome to 2021. Will, good morning.
Great to be here in 2021, and 81 is a milestone. So happy to continue.
It is. Ramsey, great to see you again. Happy New Year. And
same to you.
And we've got a great guest. So I think a very good guest on a topic that will be perfect for kicking off the new year. So do you want to do the honors of the introduction?
Absolutely. So we're delighted to have David Blanchett from Morningstar join us today. This is great. It's great to start 2021 with an amazing guest, and it's also going to be fun talking about Dave's 6 predictions for 2021. So David is the head of retirement research for Morningstar. I think probably a lot of our listeners already know who he is, or they should. And for those of you who don't, I think we're gonna learn a lot today about why he's somebody we should all be listening to. So with that, David, tell us a little bit more about what you do with Morningstar, and then we'll dive into the top 6.
So, to start, I have to unleash some nerd credentials here. So my mom was a math teacher. And so I grew up loving numbers. And so, as soon as you said episode 81, I'm like, wow, that's both a square and a cube. That's a really important episode to be on. So I'm going to just leave that alone for now. But as soon as I heard that, that's the first thing I thought of. But at Morningstar, I help us create solutions for investors, largely in the robo space. We have a tool called Managed Accounts that uses in 401k plans. Also other kind of more generalized solutions across the firm. So retirement research is my focus, and we kind of build solutions in different areas. So super high level.
Fantastic. So you published at the end of last year a number of predictions. And one of the things that you said, speaking of sort of statistically, one of the things you said in your post was, batting 400's pretty good, and you hope you'll bat 400 on it. I think my bet's on 4 out of 6. I think 4 out of 6, 3 or 4 out of 6.
All right.
There.
Okay.
But either way, I thought that was a very healthy way to think about it, because the world is not about being absolutely right. It's about finding the right direction. And if you can bat 400, that's a good place to be. So why don't we get right into it, and maybe each one of us can take one of these as we go along. But the first one is the search for yield will continue. So tell us about that. We think that means to investors in the coming year.
Well, this means a lot of different things. When I think about the search for yield, it's just a portfolio that achieves some kind of reasonable return. And if you're an investor right now, these are trying times. It's impossible to predict what's going to happen in the future with respect to markets. But, if you buy a bond that yields 1%, you're probably going to earn about 1%. Equities, there's obviously questions about what they're going to do. But, people talk about long-term averages. Well, the long-term average return on 10-year governments is 5%. The long-term return on equities is 12%. We don't think that that's realistic, Morningstar, others, for the foreseeable future, but people have to achieve some kind of return to accomplish their goals. And so I think that whether that means taking on risk or looking for new products, people have to do something today to accomplish their financial goals, because if you don't achieve a higher return, you've got to save more, and no one wants to save more. So to me, it's just looking for returns in unique places given the market environment.
So unique places and stretching for yield. As an insurance company, if I were a chief investment officer, yikes. So Dave, does that imply that we're all going to have to go out on our skis a little bit to meet the commitments that people are expecting?
Probably. Again, when I think about a retiree, you've got different levers that you can adjust. You can retire later, you can spend less, you can, increase your return. if you're not going to achieve the returns that you would forecast in a financial plan, it means something has to change. And so I think that a lot of the times I hear advisors are making their portfolios for clients more aggressive. That scares me a little bit, right? Because all you're doing is you're just leveraging your outcome. You're just saying, hey, I can't get there with a 60-40 portfolio. I'm going to turn some risk on. And so then what happens if the market drops 30 or 40%? You're in worse shape than you started. And so, it's funny. I do think there are different products to think about. Before we actually jumped on this, I was working on some research I'm doing with Michael Finke, looking at like fixed rate annuities, also called MYGAs, right? These things are crazy from a return perspective, in terms of it's a guaranteed safe investment for a term that dramatically outperforms things like CDs, treasuries, everything else. And so, like, to me, like, that's one example of a product that, I don't know, maybe didn't make a ton of sense a decade ago, but like right now, if I'm an investor saying, hey, I've got to earn some return out of my quote unquote safe assets, that would be one place to possibly look.
We agree.
What do you guys think?
We agree wholeheartedly.
We're with you on that, David. But even then, like if you look at the rates and there's nothing here that's I don't know, that's so pronounced where people are like, yeah, that's the solution. There's, to your point, there's a lot of levers, and that's one area I think to look to.
Well, and I will tell you, because we actually do, sell MYGAs, and we do have a direct affiliated program with agents selling these to clients in sort of new digital ways. So you just asked a great question. We got to, when you talk,
for the record, like that was you took it there. We didn't. We weren't asking for that.
Here we go. But it's very interesting, Dave. The psychology of investors. One is you say, hey, let's take it down to like, I started talking about the chief investment officer, but if you take it to, the chief investment officer of my own balance and bank account, I don't understand MYGAs. I've never heard of them. Maybe I understood CDs. Maybe I had some money in CDs. More likely, I've got money sitting in a money market earning, 0.0001%. Well, that's
maybe 0.01%. Come on,
0.01%. Well,
you're hitting the point home, though.
Yeah, it's very low. But wait a second, I'm going to take this money and I'm going to move it to an insurance company. To a product I don't know. And Dave, I'm telling you, on online chats with some of these consumers, they're frightened to death. Wait, I've literally had conversations where a person says, I'm talking about my retirement money. Is it guaranteed to be safe? How do you match the psychology against the need that if you're spending this much in money, you're counting on this much interest or asset income, how do you balance those two competing left brain, right brain calculations together in an environment like this?
Well, so first, like the rates don't make any sense to me at all, right? If you compare the payout rates to like comparable corporates to really anything else that is somewhat similar, like it's kind of crazy. And I think people have made that analogy, like, how is this realistic? And so I would say, well, I don't know. I'm not like an actuary. I don't do that kind of stuff. But one thing I do know is that these are guaranteed, right? And there's layers of guarantees, right? So when I talk about it, I say, hey, there's the insurer balance sheet. If you look at like cumulative default rates from AM Best, they're actually really low for A or B rated insurers. And you've got the state guarantee associations, right? And people don't understand how these work. They think they're like the PBGC. They're not. It's effectively, right? You guys know this too, but it's each insurer in that state guaranteeing the payout. But I think even beyond that, there's like this extra level of like this implicit guarantee where insurance companies can't have other insurers failing, right? If all of a sudden guaranteed investments aren't guaranteed, then that changes the industry, right? That's like that's a shock. And so from my perspective, you need to understand kind of what they are. But at the end of the day, these are guaranteed investments. And even if you have a high level of risk aversion, assume some probability of default, they actually still seem to make a lot of sense. So I think that the key isn't necessarily consumers. What's odd is like if you look at websites like Blueprint Income, I'm sure you guys have heard of them. Like they're seeing big sales from consumers. So some consumers get it. I think it's advisors that need to kind of open their eyes to these products. And I've spoken to some advisors that also do a lot of media work, and like they don't want to touch them. I'm like, well, why not? And they're like, oh, they're annuities. I'm like, well, like I get the people don't like the A word, but you've got to open your mind today to new solutions. If we go back, 5 or 10 years, and you can earn 3 or 4% on treasuries, whatever. I think that right now, if you're doing your job as an advisor, it requires understanding these products and then explaining them to clients to use as part of a total solution. I would never say put all of someone's money in a MYGA, but I mean, as part of a sleeve for someone in retirement, it's hard to beat a 3-ish% guaranteed return right now.
I mean,
Yeah, I
that's
agree with you, David, that should be part of a conversation, a broader conversation. And I think it's a necessary component or ingredient.
Yeah, I think the asterisk to put on this, and some people don't understand this, and we've had to kind of educate people. Is one is the minute you put money into this, it's a qualified account, right? So it's we're not you're not. It's unlikely you're going to be selling these things to 30 and 40-year-olds. You probably, to use this product at a minimum, you probably want to be in your late 50s, because
Right.
some of these features you don't want to trigger. It's just like putting money into 401k.
Right.
In that, as money comes out, and we'll make sure I give all full disclosures here. Money comes out is potentially subject to that 10% IRS penalty until you're 59 and a half. So it's this older. It's a good product for people who are like 55 and up, who've they got the safe money nest egg. They're not touching. They're not going to need to touch for a while.
Yeah, I think, Paul, that's why we're using the word retirement assets or retirement, objectives.
Yeah.
Because these aren't even the shorter term MYGAs. You see them now; they're out for 2 years, 3 years. You see them with attractive rates comparative to other investment opportunities. But there is taxable implications that people need to be aware of.
Right. Yeah.
Right.
So Dave, we appreciate David, you set us up, but yeah, I agree. Consumers have to start to look at some products that they have not necessarily looked at if they want to keep the rates at a reasonable rate with a reasonable amount of assurance the money's going to be there when they need it.
Yeah, well, David, one quick thing. You said something earlier that was really, really important. If you did a retirement plan and you had based it on some assumptions of a return, you have certain levers you can pull right now, and some of those might introduce risk, and others might require that you look elsewhere or you look outside the box that you had originally looked at. So that's why these conversations are so important right now, especially with this interest rate environment that we're in.
Yeah, I mean, I kind of get why consumers aren't going to do this, because the average person is not necessarily very well educated when it comes to investing. But to me, it's the pushback from advisors that just fascinates me. It's like your human capital is specifically to help clients accomplish their financial goals, and you are not considering all the options available. Like, why not? And I mean, you get answers, but some of the answers just, I think, don't make a whole lot of sense. And so I think it's really advisors have to up their game to learn about these things, because it should be in their wheelhouse of products that they think about when it comes to helping someone build a portfolio.
So totally agree. There's so much stuff to unpack there, and I'm gonna just step back a little bit on this idea of like reaching for yield in a number of different ways. One of the things that always troubles me is people talk about moving into other things, whether it's dividend paying stocks or other channels. Those are all okay, but what bothers me is people sort of make them equivalent. They're not. Like, it's a decision. It's a risk decision to go into dividend paying stocks. It's not the same as a bond. When people say they're like the new bonds, no, they're not. They're the same old stocks. They just happen to pay dividends. So like, I think the main thing is people need to be very clear on exactly what the decisions they're actually making. And then your point, this is a very interesting one about sort of getting advisors to get on board. The problem is that like annuities, the term annuities have become way too generic. It covers a lot of things that don't really meet the traditional definition of an annuity. So there's a lot of cultural issues we have to get by here. And so the question is like, in your conversations, how do we get by those sort of cultural and philosophical issues that don't really match up with the actual sort of reality? And the beauty is like, you're a trusted source to advisors. So your voice is going to matter more than most.
That's a lot to unpack in 30 minutes. And I don't even sell annuities. I work for an RIA. No, I think that to your point, the A word is such a loaded term, right? I mean, when I talk about annuities, it's really often from the more kind of like traditional perspective of guaranteed lifetime income, but they are anything but that today, right? And so, to me, I think it is a problem that one word can mean so many different things now. It can be guaranteed lifetime income. It can be, the GLWBs. It can be just all the different flavors have created this environment where like annuity, what does it even mean now? And so I don't know how to fix that, but I think it is a problem because, a mutual fund is a mutual fund, a CD is a CD, an annuity can mean so many different things that it's really hard to figure out, often what you're actually talking about.
Got it. All right, so I'm going to move it to the next thing to robos, and I'll make my question much simpler than I did the last one. So apologies for the compound question before. So your prediction number 2 is that robos will keep rising. So what are your thoughts on sort of the growing role of robo advice for consumers?
Sure. So I got to point out I am biased to some extent. I effectively work for a company that offers a robo advisor available in the DC space called managed accounts. But and then when I say that, I really believe in the value of financial advice, and I don't think that robo advisors and advisors are mutually exclusive. I think that what we have to have is an environment where you can access advice the way you want to, and I think that a lot of people will always pay extra to have that human being in front of them. Right. But if you go back 20 years, everyone used an accountant for taxes. Okay. That was great. But, now most people e-file, they do it themselves online. I'm not trying to suggest that everyone should do that with advisors, but what I am saying is that a lot of folks don't get advice at all right now, or they get conflicted advice. And so I like the idea of different forms of advice that you can receive. And I think that people in the past might have said, well, people aren't going to be okay, with a robo advisor, you talk to someone over the computer. Well, welcome to 2020 or 2021, right? I think that all of a sudden this interest to do things online and to do, Zoom meetings with an advisor are going to increase significantly because it's a new way to communicate with people. And so I'd like to think that robos will rise, but to me the key is as robos rise, it's not like a fixed pie where they're kind of pulling people away from financial advisors. It's the collective percent of Americans that are getting advice are rising. So more folks are using financial advisors, and a lot more folks are getting advice to robo advisors, where the eventual goal is for them to maybe pivot from the robo advisor to a more traditional financial advisor.
Yeah, let me ask you the same question slightly differently, David. Do you think robo advisors potentially will clarify the value that the advisor is bringing? I know a lot of advisors who will tell me how wonderful they are at managing money.
They're all great. Everyone adds alpha.
Yeah, everybody brings alpha to the table, but is it really alpha I'm bringing? If I'm the advisor for Ramsey, or really am I a coach and a behavioral? Do I manage his behaviors? I mean, what's your perspective? How will this impact the role going forward?
Yeah, I mean, this is kind of obvious, but alpha is a zero-sum game, right? And that's before fees. We can't all, I mean, if you ever ask, if you're in a conference and you ask advisors who here builds better than average portfolios, you're going to get a lot of hands to go up in that room. But to me, I think that investment advice is largely commoditized, right? So if you go back 10 or 20 years, there wasn't, I work for Morningstar. You can get tons of really cool stuff available online for free now. There's lots of multi-asset funds by a host of companies that are really, really good. And so the notion that you're going to significantly outperform, these high quality multi-asset solutions that are prepackaged, I think is a little bit ridiculous today. I think that 20 years ago, people didn't know how to invest or what to do. It is online. It is free now. And so from my perspective, the value of an advisor, to what your point was, it's accomplishing a goal. It's the behavioral stuff. It's the financial planning aspect. It's helping someone save. Investments are part of it. Investors do make bad decisions, but that is a decreasing part of a much larger role advisors have to play to actually add value for a client.
So I have to say, I really like, Paul, what you said, the way you sort of isolated, right? A robo advice can sort of isolate, could be a benchmark for exactly what the I guess I'll call it the non-quantitative value add is for an advisor. So that's one of my first key takeaways from this.
Well, I guess
so
I would actually argue that robo advisors are actually doing almost exactly what most advisors do today. Most advisors don't do robust financial advising or planning. They build a portfolio of largely mutual funds that they rebalance at some frequency. That's all robo advisors do. And some might say, well, I do a lot more than that. But in my experience, the services that they're offering are actually relatively on par with the average advisor for a fraction of the cost. And now there isn't a local presence, there isn't someone there, but the idea that robo advisor portfolios are somehow worse or better than advisor portfolios, to me, just seems a little bit off. I don't know. But anyway, you disagree.
No. I'm trying to balance
No,
getting through all
you
these
want to.
predictions.
What do you think? You disagree?
So I fundamentally, no. I actually think that like there is actual sort of money management for the vast majority of people is totally commoditized, and it can be turned into something that's packaged. So I actually totally agree with that. What I've discovered though is that sort of this notion of being sort of a financial therapist or tying in with estate planning or helping people budget like what the future of retirement looks like, which is actually far less interesting, I think, for most of us, particularly if we're investment minded, is actually where the real value add is. And I think that's why, like, to me, this idea of a financial advisor that essentially can be tech enabled and goes robo with all the investment pieces of it, but actually focuses on answering those other questions is a pretty interesting model down the road. So I agree with your fundamental premise. I just think that like good financial advice is actually more holistic than that. I mean, we don't see enough of it. People are too often narrowly defining it as just the financial.
And just to add on to that, we've had several guests who've talked about their value add and what they're bringing to the table, in addition to a standard like asset allocation model, or connecting someone to what their desired asset allocation model is, but bringing something else like Ramsey mentioned, some kind of tax planning, estate planning, social security planning, but some type of other value add to the table to really differentiate oneself as an advisor. So there's that component as well. I think that's will be interesting to see as we move forward.
Yeah, I mean, I hope that's the future, right? I think the problem is like representativeness, right? So the people that you guys talk to, that I usually talk to, are like the best advisors in the game. And most advisors, at least the average ones that I hear about, aren't doing this like extra really cool, important value add stuff. So.
Got it. Okay. Well, they should be encouraged to
I
do
agree.
so.
I agree.
All right. Okay. Maybe we do another show on that, actually. I think that's another show. I think that's a whole show.
I agree.
All right. Next one. People will likely have to work longer even if they don't want to. This is prediction number 3.
Yeah, so this actually ties to the first one. I'm kind of reusing the idea of the impact of like lower returns. And, so one thing that like terrifies me, terrifies is maybe the wrong word, but like when I see these online financial calculators and they use purely historical returns, right? A very famous company that has a ship as a logo has an online tool that does 100,000 runs. And so someone that like does Monte Carlo, like, wow, that's a lot of runs, okay? But they use purely historical returns in their 100,000 run Monte Carlo simulation. So it's like, what's the point of doing 100 runs or 100,000 if you assume that you can get 5% on bonds? And so, my concern with a lot of these tools is they don't have accurate, assumptions. I mean, no one knows what's going to happen with respect to future returns, whatever else, but you have to have a good starting place, right? And so my perspective here is that I do think returns are going to be lower for the foreseeable future, lower bond returns, lower equities, and given rising life expectancies, at least the historical trend, I think if you're going to maintain a portfolio that's going to last 20 or 30 years, you're going to have to work longer if you can. People don't want to, but again, like that's just one of the levers. I mean, the levers are if you have X dollars saved at Y age and you want to achieve Z as a goal, you can work longer, you can, spend less, you can do these things. I think working longer, it's the most viable thing for people that actually can do it in terms of they have the ability, they got the job, things like that.
Cool. So yeah, one of the challenges that's coming up is that people may want to work longer, but working longer may, it may not be in the executive suite. It may be, being a greeter, right? At a retail store. I mean, that's the scary part is I think that there's a willingness for people to work longer. It's not clear to me that the jobs, are available. I don't have an answer for that, but I totally agree with this premise. I just think in practice it's going to be hard for people to do.
Yeah, Ramsey, I think there's some noise out there, that people may want to David's point, work longer, but they have to have the ability to do so, or a company that wants them to continue on. So it's a kind of it's a catch-22.
Yeah, I saw a great tracking poll. It's been running for, I think, at least since March, David. I can, we can put a link in our notes to it that shows consumer sentiment. And I would say that argue the stats that I've seen and the way the numbers have changed in terms of people's plans to take retirement, how long they have to work. I'd say people broadly recognizing what you're saying is you're going to have to work longer. Now, the question is where, how, when. And, Ramsey, what am I doing? Am I driving Uber? Oh, whoops.
Right.
Nobody's driving. Nobody's going anywhere right now. What do I do?
Yeah, I mean, I think the one, you guys have mentioned this, the complicating factor here is that people, when they tend to leave their job when they're older, it's mostly involuntary. They get laid off. There's an economic shock. They have a health issue. Their spouse does. And so there may be a desire to work longer, but the ability to do so, I think, is going to be what's interesting. I mean, I'd like to think we're going to, get to a place where there is an age discrimination, where workers are encouraged to work longer, but I'm not convinced we're there right now. So, this is kind of a want to, but we'll see if they actually can, based upon what they're doing, where they're working, things like that.
All right. Number 4.
You haven't disagreed with me yet, so that's coming with one of these next ones, right, Ramsey? You said there are 2 of these I had that you didn't agree with, so.
Oh, okay. All right. We'll have to review and then I'll.
Okay. I'm like, there's only 3 left, so it's going to get interesting, these last 3. So.
Yeah. So I'm going to say my disagreement on that is just that I just don't think people will be able to work. So I think it will come to pass that people will want to work longer. So in that sense, it's true. I think it won't come to pass simply because I think that in a relatively ageist society, we get old at like 40 and 50, and I'm 53, by the way. And I don't feel old, but that is the world we've become. So that's where it's that's one I count as one that won't happen simply because I think the world is not as accommodating as it should be. All right, next one: increased focus on liabilities. This will be fantastic, and I think it actually plays into what you were saying about quality advice. But tell us about that.
Yeah, so I mean, I'm relatively young, and so I have debt. We still have some student loans. We have a mortgage, and so I can't do a whole lot about my assets, right? I can't will the market to give me a higher equity return. I can't will the market for a higher return on fixed income. But what I can do is I can manage my balance sheet, and so I'm about to refinance my mortgage for the 3rd time in 12 months. Right. And so, but that's good for me in a way. And so I'm kind of accepting a lower return on my assets, but I'm also getting a lower payment on my debt. So then when they net out, I'm in good shape. We know that more retirees are getting to retirement with debt. And so to some extent, this can help them. But at the same time, the interest rate you pay on a loan is effectively a form of alpha. And I am always actively trying to achieve the lowest return possible, and I want others to as well. And so, you might not care as much when the market's going up 20% a year, but I think that today more than ever, every basis point you can achieve on the overall return of your wealth is just even more important.
Yeah, debt is a frightening issue. Yeah, no, I'm just, I think, David, you're hitting something that's enormously important. And I'm just not sure how working clients out of debt is not going to become more and more of a challenge for financial advisors, or a way to actually build a relationship. I mean, do you think, when I think of some of the debt resolution services, they've usually been around, people, they've been for people who are in deep distress. Do you think this opens up new opportunities for advisors to sort of lead with, balance sheet management services?
Well, I mean, so I think that they should be. So I have a research that's coming out that talks about the average household pays more in interest on their balance sheet than they do actually achieve earnings via their portfolio. So, the interest that you pay on your debt is more than you achieve returns of your portfolio. But how much time do advisors think about, gosh, is it 11% to small value or 10.5%? That's honestly what they do at the level to figure out portfolios. They don't do that kind of stuff typically, at least in my experience, on, can I refinance my student loans or refinance a mortgage? Do all my liabilities, are they the best possible rate? And so I think the key for me with this is just make sure that if you have debt, you're paying the lowest rate you possibly can. Now, I know that there's like hard choices, and so when you refinance a mortgage, there's the closing cost. You've got to balance a few things, but I just worry that too often advisors are just like laser focused on this hyper efficient portfolio. Then take that step back to say, hey, how can I make all of your balance sheet more efficient?
Yeah, I agree with you 100%, David. I think some advisors focus just on retirement saving, retirement planning, but they're not, the threshold issue might be a significant amount of debt and maybe at a rate that's not, that's not favorable. So that should be part of the comprehensive conversation. Most definitely.
And it should be, and I hate to generalize, right? Because advisors do so many different things. But again, like in my experience, a lot of advisors don't spend enough time on what I would call like the holistic balance sheet versus the more kind of plain vanilla portfolio management kind of stuff.
Well, there's the interesting thing is, in some sense, that's easier alpha.
It is.
Right? In some sense, you can go out, you can find an efficiency, and that's risk-free alpha, as opposed to trying to make some difference in the portfolio, which obviously requires some risk of success or failure. And I think the problem maybe is that advisors aren't directly paid for that, right?
Wait, whoa! You think that's going to affect their decision making? I can't keep going. Okay, I just come on.
No, so the most interesting thing, David, is like, so your clients are advisors, right?
Well, yeah, we also have individual investors. Morningstar runs the gamut. We help everyone out, right?
Oh, this is great.
Well, Ramsey, I mean, I appreciate your honesty there. I mean, that is something that happens. Advisors are in this to help clients most definitely, and bring value to their clients, but also to make money. So I think that's something that we can't.
Yeah, but I would argue, sort of, if I'm an advisor going down this track, David, actually, the compensation structure is actually complementary if I think of the big picture, because if I can free up, $5,000 a year in Will's. If I can eliminate 5,000 expenses, that could be 5,000 turning into an investment, or over the course of 5 years each year. So the recurring stream of income that I'm producing, that I'm now creating for Will, actually creates a bigger portfolio if I'm on an RIA, correct?
So I love the optimism, Paul. I think one of my concerns is that even me, I have excess cash flow, right? I'm a good financial planner for myself, and what do I do with it? Do I pay down my mortgage even with a low rate? Do I invest it in a 529? Well, I don't have any conflicts. Like, I'm all about maximizing my perceived effective rate of return. And so if I'm an advisor and I have a client that's got a mortgage at 3% for some reason, am I telling them to go out and buy a bond they're going to earn 1% on versus prepaying the mortgage? That doesn't make, there's reasons not to do that, right? Because of liquidity, but that's what they should be doing, right? Why would you earn 1% and pay 3%? There aren't incentives to do that, though. Right. And so I think that, when you look at the way compensation exists, it's true that on a more granular level, like, yes, if I improve someone's cash flow, they have more assets. If you do more macro focus, though, paying down debt can be a powerful way to increase your rate of return, but it can simply reduce your kind of pie of assets that you're managing.
One other thing, David, that you mentioned, this goes back to your earlier point about levers. And I think that we may see this come to fruition, but people may be carrying debt longer into retirement, maybe taking a second mortgage, taking a home equity line of credit, using that as a lever everyone kind of assumes that you had a 30-year mortgage, it's paid off by the time your kids are out of college, or all those, those kind of standard things that we expect. And I think that's also changing. And people are buying, at advanced ages, buying expensive real estate, it seems like, these days too.
Right.
So.
All right. So on this issue, and it's such an important issue, I think that unless the compensation structure changes meaningfully, I think it's going to be hard for this to happen. I'm pretty, enamored of this idea of flat fee planning, fixed fee for a fixed planning fee, year in, year out, so that you sort of eliminate so many potential conflicts of interest. That seems to be popular among younger advisors, but it still seems to be the distinct minority in the space. So I don't know, any thoughts on that before we go on to the next one?
I have had a debate about advisor compensation models, in a variety of forms, and they can get pretty nasty, actually. I'm surprised, to me, like what other profession is like, hey, how much do you charge for your services? How much money do you have? I'm going to charge based upon that, right? I mean, like that's not what accountants do. That's not what lawyers do. And I don't love the idea of billable hours. I like the idea of like a retainer with like a small basis point overlay. You can do that via basis points too. But to me, like the idea that I'm going to charge you 1 point on your assets, I think it just doesn't reflect the true marginal value of what you're doing because of the commoditization of the investment advice, along with what you should be doing, which is helping someone accomplish their financial goals. So I'd like to see a change, but the industry is not changing at all. If anything, I think it's moving towards basis points and away from any kind of commission-based model. So we'll see.
Okay, all right. Again, Paul, that's another show. So
it is. It is.
Really,
you're not asking
right.
me.
There could be a lengthy conversation on that.
They're number 5. The search for an easy button will continue despite the fact that there isn't one.
Yeah, I mean, so there's all these rules of thumb out there, like the 4% rule. And I actually really like rules of thumb because you cannot explain a lot of this stuff to the average person, but I want them to have at least some idea of what they should be doing. And so, I actually like the 4% rule because it gives you some kind of starting place for what is realistic. Is it 8%? Is it 2%? I don't know. 4% is not too bad. The problem is that, that should be like the first place you start. And ideally you use that to kind of just have a really simple rule of thumb, and then you get a personalized estimate based upon your situation. And I mean, the issue with retirement is it's so incredibly complex. There's a lot of irrevocable decisions that you make when to claim Social Security. Maybe you're going to buy an annuity, whatever else it is. And so I think that people need these rules of thumb. They need easy buttons, but in reality, you also need to have then, after you kind of have a base understanding of what is the starting place, is what is the right strategy for you. And I just again, retirement is just so complex. I just don't believe that there is one. There's generalized rules you can follow, but this is where the value of advice is just so important. Is helping someone understand what they should do given their goals, objectives, preferences, assets, etc.
Well, we spent a fair amount of time talking about the 4% rule in this podcast over the last year. So we had Wade Pfau on. We talked about it there. He called it the 2.2% rule.
So that's ridiculous. And so I've done research with Wade on this exact effect. Okay, and here's the thing: people don't increase their consumption annually by inflation. That's just a fact. Right? People aren't going to be destitute when their portfolio fails, right? People don't even tend to spend the assets that they have. And so, none of the early research on withdrawal rates incorporates the fact that people actually have money if their portfolio fails. It's like, oh my God, the portfolio fails and I'm going to be totally broke. The actual rule, I think 4% is a great starting place for most people because you know what? They're not going to spend it every year by inflation. They've got Social Security. And what you don't want to do is scare the bejesus out of people. Like I've seen planners do plans that assume a 99% success rate at age 110. That's ridiculous. I think it's a balance of, the questions like, hey, if your portfolio happens to not do well, can you afford to cut back? Well, if you can't, maybe it's like 3.5%. But I think that 4%, it makes a lot of sense when you understand where the number came from, what its flaws are, everything else. So that's just me.
David, I like your perspective on the rules. If you start with the number in the right context, it's a great way to start a conversation and start to address some of those emotional issues that people have around, oh my gosh, I'm not going to ever be able to retire. Well, Paul, you may be able to retire. It just may not be the style that you think you would want to live in, right? I think it's a good point. And yeah, right. Is it half the money that you thought you could generate? Is it twice that generate? Well, at least you have some you've got some thresholds where you can see what the possibilities are of what your future life may be like. What's the future of the rules of thumb? I mean, from your perspective, I mean, what is the next 4% rule?
I mean, so you could do. We've done all this research on the adjustments to 4% rule. Like, if you correctly incorporate mortality, like you shouldn't plan for a fixed period, right? The true failure is being alive and broke, not being broke over a 30-year time horizon. When you incorporate dynamic withdrawal strategies, and it gets really, really complicated, right? And so, like is 4% perfect? nah, but it's out there. It kind of makes sense, I have a rule that no one follows. I call it the rule of 61. If this gets to like retirement age, and so every year past age 61 that you plan to retire, you actually retire a half a year early on average. There's all this data from the HRS you can look at that says, okay, and this is I think a problem with a lot of financial plans. Someone's going to say, hey, you're going to retire at age 65. That's not going to work. We're going to push it back to age 69, and then things look great. The problem is, when you move that back 4 years, reality, it's only going to be age 67 on average. And so people, there's all these things that you can do, and that's not perfect for every occupation and everything else. But, rules of thumb, again, I think that they work for the most part. I haven't seen one that I absolutely hate. But the 4% rule, people give it a really hard time. But I think if you really understand it in the context of retirement, what's realistic. I used to be a financial planner. What people actually have, it actually is a pretty good place to start in the grand scheme of things.
I do. I agree with you, David, that's not, it's not scaring them, to borrow what you said, but it's not overpromising. It seems to be a balanced or reasonable starting point to start the conversation.
Yeah.
All right. Thanks for that. So that's a good counterpoint. Again, we're setting the stage for the future here.
Yes.
All right. So last one, if I can get to it here. Last one is an annuity advertisement. All right. No, here we go.
Well, kind of.
No, somebody.
Oh, I know. No, it's about it.
It's Google. It's Google doing this, not me.
Yeah.
All right. All right. But the last one is on annuities. Imagine that. Annuities, especially those focused on guaranteed income, will continue to suffer. So tell us about that.
Yeah. So, and this is more focused on, when if I can call myself an academic, we use the A word. It's around like SPIAs and DIAs, right? The more traditional forms of guaranteed income. I mean, let's be honest, no one has almost ever bought these things. We spend all this time talking about them, but they're not widely utilized. But, in theory, in times of market distress, demand should increase. It has in the past. Well, we had a bear market, I think, in 2020, but we've long since rebounded, so that's kind of gone as it is. But I think the low rates make it problematic because you're effectively buying a long duration bond, at a relatively low price point. Now, we can obviously talk about how annuities are actually relatively better than fixed income when rates are low, whatever. I think it just makes the decision harder, right? There's already all these behavioral, biases against more traditional annuities like SPIAs and DIAs. I think it's going to be harder for those products to kind of gain traction. And so I think it's the products that have the GLWBs that could actually do better. I probably should have caveated this better in this 6th point, but I think it's those traditional kind of irrevocable decisions that are going to be tough for people right now.
So basically you think that if I'm to sort of in a nutshell, maybe that annuities that allow their the holders to maintain some amount of control or be able to get their assets back are going to be more attractive.
Well, and again, so it's kind of this, when I think about annuities, and this is those on lifetime income, there's this Venn diagram of the products that exist, behavioral implications, and I forgot the 3rd quadrant that I talk about. But what you want is one that kind of meets in the middle, right? This idea that we're all a bunch of utility maximized robots is what I do research on, but no one actually does the things that we talk about. And so it's figuring out what makes the most sense behaviorally that actually leads to the best outcome. And sure, if interest rates were super high, annuities would make a lot of sense. But right now, the question is well, how do you get clients to, access the benefit of mortality credits? And it's going to be a really hard sale to get them to buy a SPIA, I think. And so I think that, other products that have attributes that might reduce payments, those that have a GLWB might have lower payouts, but there is an implied value to the revocability. And so I think, because SPIAs and DIAs are a harder sell, pivoting to different types of products might make a lot more sense because, again, you're getting some assets into the guarantee versus having little or none.
Excellent. So that's 6. So Paul, Will, any other thoughts here? Maybe we go back through these quickly and each of us vote.
I do think we should have, if David's willing, we need to have a follow podcast to see how these predictions play out and maybe, even boil a couple of them down further as the year progresses. Because there's a lot there to even discuss in a half an hour. And I think we'll see some level of illumination as we, even in the Q1 into Q2 on some of these predictions.
No, and I'll tell you my reaction here, David, on all this. I think these are great. I think great predictions is layering on this crazy pandemic in the world we're in, right? Like, I think it adds a whole nother dimension of stress. Like, what are the risks, right? Who would have thought that or perceived that the travel industry and the hospitality industry as fragile as it is for health concerns, right? What are those risks out there that I'm really balancing against that I may not be aware of, come 2021? Optionality. Yes. Right. I mean, optionality squared this year, right? I just don't, how is my money going to perform? Will I have a job at the end of the year? Right. I think, all those issues you've raised, I think are just going to be magnified in 2021. And we're in odd ways that we won't necessarily see until we see them 8 months later.
Well, my favorite odd statistic is, someone would have asked me, David, like, what do you think happened to traffic deaths since COVID started? I'd be like, well, I mean, it's, traffic is way down, so they've gone down too. Well, they've actually gone up, right? I don't think if you asked a bunch of people that question, everyone would say, well, if there's less traffic on the road, there's less traffic deaths. Well, it's actually the opposite. And so I think that's what's so hard about this right now is that there's all these unintended consequences to what we're doing. And so, these are, I think, pretty safe predictions, but, how the pandemic unfolds and how it affects our lives in the future is still this great unknown. I mean, I haven't been on an airplane in 9 months. I used to be on an airplane every week. And a lot of us, it's changed our jobs. It'll change a lot going forward that we don't know how or when or where, right?
Right. Ramsey, what will we do with our newfound superpowers after we all take this vaccine?
Yeah. Well, I think I wanted to ask David was, so your job has changed a lot. You were a road warrior and now you're not. Like, how do you like your new life? Do you want the old one back, or are you happier now with this?
So I'm an extroverted researcher. I really enjoy doing research, but I also really enjoy talking to advisors, going to conferences, and just being around people. I love my wife and children, but I just sit here at my desk every day, and I do things like this, which are a lot of fun. But I do miss the engagement aspect of my job. I mean, do I have to travel 2 or 3 days a week forever? Maybe some of that we can get rid of, like those trips out to LA for a finalist presentation where you sit down for an hour and you fly back home, you waste a day and a half. Like, we don't need to do those, but I honestly do miss seeing people and going to events, because I'm on Zoom 4 to 6 hours a day right now, and that's not, to me, a fun way to have a job. And I mean, I am remote, so I live in Kentucky, and Morningstar is in Chicago, but I do want some of what used to be normal back, maybe not all of it. But I increasingly enjoy my job less because I just sit and do research all day, every day. I don't have that break, of the engagement interaction with other people. So.
Sure. All right. Well, look, you've been very generous with your time. This has been a great discussion. I'm going to stick to my 4 out of 6. I think 3 and 4. Actually, I think all 6 of these things are desirable. I think 3 and 4. Just to remind people, number 3 is people will likely have to work longer, even if they don't want to. I don't think as many people will be able to as would want to. Certainly not in 2021, unless things change. I think that will take longer. And then number 4 was an increased focus on liabilities. I think that's exactly the right way to do things. I don't think that's the way the advice community is wired. And I don't think that's the way consumers are wired yet. So I think for me, those are the 2 things I'd like to see happen. I think it won't happen in 2021. I think the other 4 items you mentioned will get there. Again, thanks very much. Paul, Will, the whole crew, just really psyched to be back at this again in 2021. David, if you haven't figured it out already, we're going to have you back. So anyway, with that, I'll turn it over to Paul.
Hey, yeah, listen, thanks, David. Thank you, Will. Thanks, and thanks to all our listeners who made 2020 a success. And listen, give us your feedback, give us your ideas, questions, and guests you may want to have on here. And tune in again for next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.